It's Wednesday, October 23, 1929. You're standing on Wall Street. The air is electric. The Dow Jones Industrial Average is trading at 326, just 5 years ago. In 1924, it was at 100. That's a 326% gain. Fortunes aren't just being made, they're being printed. Everyone you know is a financial genius. Your barber, your tailor, the shoeshine boy on the corner. They're all giving you stock tips, and they're all good. You're hearing one name whispered everywhere: RCA, Radio Corporation of America. Reka stock has never paid a single dividend. It has never earned a single cent of profit. In the last 18 months, its price has multiplied 500%. From $85 to over $420 a share. This isn't a market. It's a new era. It's a party that will never, ever end, or so they thought. In less than 24 hours, the first crack would appear. In less than 140 hours, this entire world would be turned to ash. The noise you hear in celebration, it's the sound of the final few seconds of pure madness. To understand the financial world we live in now, we have to go back. We have to understand exactly what happened in those final hours. The 1920s weren't just a boom. They were a fundamental shift in the American mind. We had the automobile, we had the radio. We had factory lines building things faster than ever. In August of 1929, an article by John J. Raskob, a General Motors executive, was published. The title was, "Everybody Ought to Be Rich." His plan was simple: save $15 a month. Invest it in good common stocks. Let the dividends reinvest. In 20 years, you'd have $80,000. That's $1.5 million in 2025 money. But people didn't want to wait 20 years. They had a new invention to get rich now. It was called buying on margin. It was the jet fuel poured on the 1920s fire. Here's how it worked. You wanted to buy $1,000 of RCA stock. You didn't need $1,000. You didn't even need $500. You only needed $100, just 10% down. Your broker would loan you the other $900. When the stock went from $1,000 to $1,100, you didn't make 10% on your $100. You doubled your money. You made 100%. The public debt for this was called brokers' loans. In 1926, these loans totaled to $0.5 billion. By the fall of 1929, they had exploded to $8.5 billion. That's $130 billion in today's money. It was a tower of debt, resting on a pinhead of rising prices. And the pinhead was starting to wobble. The summer of 1929 was jittery. The market hit its all-time peak on September 3rd. Then it dipped. Financial expert Roger Babson gave a speech on September 5th. He warned, sooner or later, a crash is coming. The market dropped 3%. They called it the Babson break, but it recovered. It always recovered. The famous Yale economist Irving Fisher gave his response. Stock prices have reached what looks like a permanently high plateau, but beneath the surface, the smart money was leaving. The big bankers, the insiders, they were quietly selling their holdings to the barbers and the shoeshine boys. The party, they knew, was over. They were just waiting for the lights to come on. And then came the morning of Thursday, October 24th, Black Thursday. The market opened high, but the trading was heavy. At 10:25 a.m., a single block of 20,000 shares of General Motors sold. Then another, and another. It was like a dam wall springing a leak. Then the leaks were everywhere. By 11 a.m., the selling was a torrent. The floor of the New York Stock Exchange descended into pure chaos. Men were screaming, shouting, running, but the real terror was the ticker tape. The ticker was the 1929 version of the Internet. It printed stock prices on a thin strip of paper. It was the only way to know what was happening, and it couldn't keep up. At 11 a.m., it was running 16 minutes late. By noon, it was 50 minutes late. By 1 p.m., it was 90 minutes late. Think about that. You're in a full-blown panic. You need to sell your stock, but you have no idea what the price is. The last price you saw was from an hour and a half ago. You're flying blind, straight into a mountain. Crowds began to gather outside the exchange. 10,000 people, just staring at the building's doors. They were watching a ghost. The prices being posted in brokers' offices were from a market that no longer existed. By midday, the Dow had lost 11% of its entire value. The dream was dead, but here's where the story gets cinematic. At 1:30 p.m., 5 of the most powerful bankers in America met. They didn't meet at the exchange. They walked across the street to the offices of J.P. Morgan & Co., 23 Wall Street, the coroner. You had Thomas Lamont, the acting head of Morgan. You had Charles Mitchell of National City Bank, Albert Wiggin of Chase National, George Baker Jr. of First National. They were the generals of American finance. Reporters swarmed them. "What's happening? What are you doing?" Thomas Lamont stepped forward. He was the picture of calm. He told the press there was just a little distress selling. He said the bankers had met. They were forming a pool, a $240 million fund to support the market. It was a war chest. The press ran with the story. Bankers pool to support market. At 1:30 p.m., Richard Whitney, the vice president of the exchange, strode back onto the floor. He was the banker's man. He walked to the trading post for U.S. Steel. It was trading at $190. Whitney bellowed an order, 205 for 25,000 shares. He was bidding above the market price. It was an injection of pure, uncut confidence. He then walked to 20 other blue-chip stocks, AT&T, General Electric, and he bought them, in huge blocks. The panic stopped instantly. The wave of selling hit the banker's wall and broke. By the end of the day, the market had recovered. It closed down only 6 points. The bankers were heroes. The papers called them the saviors of Wall Street. The crisis was over. The new era was saved. It wasn't over. It wasn't even close. On Friday, October 25th, the market was stable. It even rose slightly. President Herbert Hoover himself made a statement from the White House. The fundamental business of the country is on a sound and prosperous basis. The public read their Saturday papers with a massive sigh of relief. The stock market was open for a short tour session on Saturdays in 1929. It was quiet. It was stable. The bankers had stepped in. The president was confident. The experts were bullish. Everyone went home to enjoy their Sunday. But inside the banks, a different story was playing out. The bankers' pool had spent $240 million, and it had barely held the line. They realized the flood of selling on Thursday was in just a little distress. It was a tidal wave. And they had just used their last sandbag. They were shaken. Worse, they were angry. They felt they had been forced to buy stocks at high prices. While other outside banks had done nothing. Or worse, had sold into the bankers' rally. They agreed to meet again, but the unity was gone. And all across New York, the lights in brokerage offices burned, all Saturday night, all day Sunday. Clerks and bookkeepers collapsed on their desks, sleeping for 20 minutes at a time. They weren't celebrating, they were calculating. They were adding up the $8.5 billion in brokers' loans. They were checking the new, lower stock prices from Thursday's crash. And they were sending telegrams, hundreds of thousands of them. Margin call. A margin call is a simple, brutal document. Your $1,000 stock is now worth $700. The $100 you put down is gone. You are now losing the $900 we loaned you. Put up more cash by 10 a.m. Monday, or we sell your stock. On Sunday, October 27th, hundreds of thousands of Americans opened these telegrams. The geniuses from the barbershop, the New Era investors, they were being wiped out. They didn't have more cash. They had put all their cash into the market, which meant, by law, their brokers had to sell their stock on Monday morning, no matter the price. Which brings us to Monday, October 28th, Black Monday. The opening bell rang at 10 a.m. It wasn't a panic. It was an avalanche. The wave of forced margin call selling hit the market. There were no blue-chip buyers this time, there were no heroes. The bankers met. But this time, the meeting was different. Charles Mitchell, Sunshine Charlie, was furious. He said his bank would not buy another share. The bankers' pool did not act. The floor of the exchange looked to 23 Wall Street for rescue. And 23 Wall Street was dark. The public realized the truth. There was no pool, there was no plateau, there was no one coming to save them. The selling was relentless. The ticker tape fell behind. 90 minutes, 2 hours, the Dow Jones Industrial Average fell 38 points. That was 13.47% of its entire value. The ticker tape failure meant some trades weren't even recorded. The system itself had broken. The headlines for the morning papers were brutal. Stock market crashes, panic selling grips nation, billions lost. The bankers made one last, desperate, pathetic attempt. They leaked to the New York Times that they might step in, but they added a condition. They would only buy if outside investors joined them. It was a bluff, and everyone knew it. They were admitting they were powerless. All over the country, people who were rich on paper on Monday were bankrupt by Tuesday morning. They had one last, desperate hope, a morning rally, a dead cat bounce, a technical correction, anything. Tuesday, October 29, 1929, Black Tuesday. The stock exchange building was surrounded by police. A crowd of 10,000 people stood in the street, staring at the building's doors. The New York Times said they were watching a funeral. Inside, the visitors' gallery was packed. This was the hottest ticket in town. They wanted to see the madness firsthand. At 9:30 a.m., the floor traders took their posts. They were holding fistfuls of sell orders, orders that had piled up all night, from margin calls, from panicked investors in London, Paris, and Berlin, from small-town banks, from rich speculators. At 10 a.m., the opening bell rang. It was a sound no one from that day ever forgot. It wasn't a bell, it was a roar, a human roar of sell, sell, sell. The sheer volume of sell orders was so large, it broke the market's opening. There were no buy orders. For entire minutes, billion-dollar companies had no bids. ATL, U.S. Steel, General Motors, Radio Corporation of America. The stock for the Morgan Bank itself opened at a $200 loss. The system of specialists designed to make a market was vaporized. This is the pure madness of the title. The floor of the exchange became a human nightmare. The 1,100 members of the exchange were in a fist fight. Men clawed at each other, screaming, shouting, crying. A broker was seen grabbing his hair and just pulling. Another just sat on the floor and wept. The ticker tape, it was a joke. It fell to 0.5 hours behind. By 10:30 a.m., the ticker was still printing trades from the 10 a.m. open. The entire country was blind. Imagine selling your life savings and not knowing if you got $50 a share or $1 a share. The ticker tape in Boston was even worse. It was for 0.5 hours behind. The entire country's financial system was reduced to rumors. Winston Churchill was wiped out. He was. The Rockefeller family is buying. They weren't. Not yet. Men are jumping from windows. That last one became the myth. While there were suicides in the coming weeks, the jumpers on Black Tuesday were mostly a dark rumor. The reality was almost worse. People were paralyzed. They just stared at the ticker, watching numbers that spelled their doom. Arriving to 0.5 hours too late. A famous story from the day. A stock called White Sewing Machine was trading at $48 a share. A broker, in a fit of black humor, put in a bid. $1 for 10,000 shares. The bid was filled. Instantly, he had just bought 10,000 shares for $1 a share. The seller was a bank that was so desperate for cash. They had an order. Sell at any price. The company was worth $480,000 one minute, and $10,000 the next. That was the madness. So let's talk numbers. The final, brutal numbers, on a busy day in 1929, maybe 4 million shares were traded. On Black Thursday, 12.9 million shares were traded. On Black Monday, 9.2 million shares were traded. On Black Tuesday, a new record was set. 16,410,030 shares were traded, a record that would stand for 39 years. By the end of the day, the Dow Jones fell another 11.7%. In dollar terms, $14 billion in shareholder value was erased. On that one day, combined with Monday's losses, the total for the two-day crash was $30 billion. Let's put $30 billion in context. The entire United States federal budget for 1929 was $3 billion. The government could have run for 10 years on the money lost. The total cost of World War I for the United States was $32 billion. Wall Street lost the equivalent of a world war in 48 hours. The market closed at 3 p.m. The exhausted, ruined men stumbled out onto Wall Street. The ticker tape kept running. It didn't finish printing the day's trades until 7:45 p.m. The cleaning crews came in, sweeping up piles of paper, torn up orders, margin call telegrams. The physical trash of a financial apocalypse, which brings us back to Irving Fisher. His permanently high plateaued, it was gone. The $8.5 billion in brokers' loans, they were called in. They bankrupted both the lenders and the borrowers, and a system that's too slow to report it. Today, we don't call it margin, we call it leverage. We have 100-to-1 leverage in derivatives. We have high-frequency trading that moves at the speed of light, not to 0.5 hours behind. We have meme stocks with no profits. Just like RCA, we have experts telling us a new era of AI and tech means the old rules do and apply. So, which do you think is the bigger threat today? The modern speed of our automated systems, or the exact same human madness that gripped Wall Street in 1929? Drop your prediction in the comments and subscribe, because we're going to track this and see who was right.